While the U.S. economy has recovered from the depths of 2020, there may still be a few stumbling blocks in the remainder of 2021 and beyond. The stock market made a significant comeback in the second half of last year and has remained hot since then. However, if the market cools or inflation continues to rise, investors should remain disciplined. Build a portfolio that includes at least some lower-risk items to help you despite future market volatility. Hello, this is Flawless Finances, and in today's video, we'll speak to you about 7 low-risk investments to help you grow your money safely. But before we get started, please subscribe to the channel and switch on alerts to be notified of new videos. Investing can be frightening, especially when you're just getting started. When it comes to increasing your financial portfolio, we understand that things can get risky when times are difficult. Low-risk investments have become a trendy issue, as some assets may take an unexpected turn. During times of uncertainty, it's fair to seek safer investments. There are many low-risk options to consider. Keep in mind that each investment comes with its own set of risks and rewards. While each investment kind performs and operates in its unique way, they all share some common characteristics. They are designed to invest money, charge interest, and, hopefully, generate a profit for you. There are numerous aspects to consider when it comes to comprehending the terms and condition of low-risk and high-risk investments. To completely understanding each type of investment's terms and conditions will require in-depth research and more specific details. In this video, we've outlined a few typical investment options to get you started and guide you to the types of investments you may be interested in. You may be aware that riskier investments have a larger chance to yield higher profits, while, on the other hand, less risky investments often result in lower yield returns. But that doesn't rule out the possibility of profiting from your investments. You don't even need more than $100 to get started with several low-risk investments. If your goal is to protect cash and provide a consistent stream of interest income, it may be worth considering. If you want to grow your money, though, you should explore investment strategies that are tailored to your long-term objectives. Even higher-risk investments, like equities, such as dividend stocks, have aspects that have lower risk while still giving good long-term returns. Let's talk about what to consider before we unveil the list of these low-risk investments. A few situations could play out depending on how much risk you're prepared to take. For example, if you believe you will never lose a dime on your principal, you are playing in the no-risk category. However, if you believe that you will break even or lose a tiny amount of money over time, you are playing in the some-risk category. However, there are 2 caveats. Low-risk assets pay lower returns than higher-risk investments, and inflation can eat away at the purchasing power of money held in low-risk investments. So if you invest in low-risk assets, your purchasing power will erode over time. That is also why low-risk bets are better for short-term investments or putting money aside for an emergency fund. Bigger risk investments, on the other hand, are better suited for higher long-term returns. Now let's start our list. The index funds are first on the list. Individual stocks and bonds, such as ordinary and preferred stocks, are not diversified. Stocks and bonds can only be purchased from 1 or 2 firms, making them inherently risky. What happens if those businesses fail? You can invest in hundreds or thousands of individual stocks and bonds using index funds. This significantly reduces the risk you take investing while producing high interest or dividend rates. PIMCO's Bond Fund and Vanguard's BND and VDADX Dividend Appreciation Funds are examples of diversified, higher-rate funds. Next are the dividend-paying common stocks. In the current low-interest rate environment, aside from preferred stock, several common equities are also relatively secure possibilities for investors seeking a larger income. Real estate investment trusts, REITs, and utility equities, for example, have traditionally been set as safer, less volatile, and more predictable dividend payers. According to statistics examined by NYU's Stern School of Business, REIT dividends paid 3.93% on average in January 2020, while utility dividends pay 3.11%. It's best to stick with strong, dependable businesses that have been around for decades and provide steady, predictable predictable dividends, not growth stocks that live and die on investor enthusiasm, no matter what industry you invest in. Remember though, that common stock dividend payments aren't guaranteed, and you could lose money if you invest in them, just like any other asset. Now, we have the preferred stocks. Preferred stock is a cross between stocks and bonds, in that it provides some of the upside potentials of common stocks while also delivering the steady income payments of bonds. Preferred stock, in fact, usually pays bigger dividends than corporate bonds, since, unlike bonds, payment is not guaranteed. As a result, preferred stocks have provided average annual returns of more than 7% since 1900, with most of these returns coming from dividend payments. A repurchase may increase the value of your investment in addition to dividends. Because preferred equities pay larger dividends and thus cost corporations more, many companies have recently purchased back preferred shares, usually at a slightly higher price than they were sold for. Hello there, mate. If you are enjoying this video, please give it a thumbs up and share your opinions in the comment section below. We'd love to hear from you. Returning to our list, we have fixed annuities. Fixed annuities are a type of annuity contract in which investors pay a fixed sum in exchange for a succession of payments over time. Fixed annuities function similarly to certificates of deposit in that you agree to give up access to your money for a specific length of time in exchange for a higher than average interest rate. According to Blueprint Income, a fixed annuity marketplace, fixed annuity interest rates range from roughly 1.0% to 3.60% as of mid-August 2020. However, higher interest rates are frequently associated with less reputable insurers, implying that they are more likely to default on payments. Keep in mind that if you need access to all of your money before the fixed annuity's maturity date, you may be penalized. In most cases, though, you will have penalty-free access to a portion of your money each month. Money market mutual funds are next on the list. Money market mutual funds invest in short-term securities such as overnight commercial paper. Even the finest money market funds often pay next to nothing in terms of returns. Unlike Treasury and corporate bonds, money market funds provide investors with absolute liquidity. They have little volatility and you can withdraw your money at any moment. Many banks also provide money market mutual funds, which is worth noting. You may be able to invest in money market funds through your bank if you don't have or want to open a brokerage account. We also have the corporate bonds on this list. High-grade corporate debt could be a smart alternative if you're ready to take on a little more risk in exchange for greater yields. These bonds, issued by well-established, high-performing firms, often provide higher yields than Treasury bonds or money market accounts. According to the St. Louis Federal Reserve, 10-year high-quality bonds have an average interest rate of 2.36% as of June 2020. Investing in high-grade corporate bonds is typically safe, although you can still lose money. You can lose money if interest rates rise. Because the interest rates that bonds pay are usually fixed for a set period, your money may not earn the higher rate. If you need to sell your bonds, you may end up selling them for less than you purchased them if interest rates have generally increased. You can also lose money if the issuer goes bankrupt, in which case you will receive your face value plus interest if you maintain your bonds until maturity. So even though investment-grade bonds are typically seen as safe investments, they aren't as safe as cash in a bank account. That's why it's crucial to concentrate on debt issued by well-regarded corporations that are more likely to repay you. Take into consideration that organizations with lower ratings may offer higher interest rates, but they are also more likely to lose money. Finally, there are Treasury notes, Treasury bills, and Treasury bonds. Government bonds, which offer interest rates ranging from 0.09% for 1 month to 1.23% for 30 years as of mid-August 2020, are your first and best option if you want to earn a slightly higher interest rate than a savings account without taking on a lot of additional risks. Bonds issued by the United States Treasury are backed by the government's complete faith and credit, which carries much weight. The United States has always paid its bills on time. If you need cash before the debt matures, government debt is more dependable and easier to buy and sell on secondary markets. On the other hand, bonds may have lower yields than bonds where the debt is less likely to be repaid, such as corporate bonds. Remember, you should always have accessible cash on hand in the form of a liquid savings account in case of emergencies. You do, however, have options for money that you need to be somewhat liquid, yet want to make a larger return on. Even when interest rates are low, money market funds, annuities, government, and high-grade corporation debt are some of the best low-risk, high-yield options to increase your money. That concludes today's video. Please subscribe and switch on notifications to be notified of new videos. This is Flawless Finances, and we'll see you in our next video.